Welcome everyone. Gross profit margin and operating profit margin. There in this previous session, we talked about the gross profit margin calculation and operating profit margin calculation. Operating profit margin is operating profit expressed as a percentage of turnover. So gross profit means gross profit expressed as a percentage of turnover. Okay, look at this activity number 1, case study Santos Metal Products. The metal products of scaffolding and metal components for the construction industry in 2013 and 14, the company received a flood of orders of supplying scaffolding to firms involved in construction work to Rio Olympics in Brazil. So, we provide a summary of their profit in 2010 to 2014. You can see they have provided those years of figures: revenue, gross profit, expense, and operating profit. For 2010, 12.4, 13, 14, 19, 24, now 24.1 million is there, and then this is a Brazilian currency, and then gross profit margin increased from 4.9 million to 12.3 million, and expenses increased from 3.9 million to 9.7 million, and operating profit rose from 1 million to 2.6 million. So by looking at the revenue figures of the Santos Metal Products between 2010 to 14, they're asking 4 questions. How has the company performed? And what impact has the flood of orders held on Santos Metal Products? Work out the both years, the gross margin and the operating profit margin, the both years, gross profit margin and operating profit margin, 2013 and 14. And final question they're asking, discuss the possible reasons for the changes in the question 3 between 2010 and 2014. What's the main reason to improve in this? So normally by looking at the figures, we can see there's a company performance has an improvement. By looking at that, we can say just roughly the company performance has improved. The profit, you can see the bottom line increase from 1 million to 2.6 million is more than double within these 5 years. And also gross profit margin also same, 4.9 million to 12.3 million. It's almost more than double. So you can see performance wise by looking at the bottom lines, you can say roughly the company has performed very well. And the flood of orders has very impact because they are targeting the Olympics. Right, and then Rio Olympic, they got a huge order for their metal because the construction of the components, because construction equipments like scaffolding, metal components, so a huge demand for that, especially when they are working with the Rio Olympics in Brazil during 2010 to 2014, because they are targeting that Rio Olympics in that year 2014. And then you can see they when you are increasing the demand for that year, they had to prepare from the beginning. From past couple of years, you can see this they're planning, and then as a result of that, they got huge orders. You'll see how the answer like this you can answer. You can see a question 1 how has the company performed? So when you're asking this question, you can say revenue. What happened to revenue? What happened to profit? So and then you can see at the end what happened to the company performance. So revenue has increased significantly. Between 2010 and 2014, it has increased by nearly 100% from US $12.4 million to US $24.1 million. This suggests that the Santos Metal product has performed very well indeed. So this is the way you can't just say it has performed very well. You have to give the evidence, facts and figures. Figures you have to say the company performance revenue significantly improved from 2010-14 from 12.4 million to 24.1 million, and this suggests that the Santos Metal Products has performed very well. And second question they're asking, what impact has the flood of orders on Santos Metal Products? So table, this is another facts and figures, a linking thing. Link in the table, sometimes it can be an examination, like a figure 1, figure 2 like that. So according to this figure, shows that the both gross profit and the operating profit rose sharply in 2013. This occurred at the same time as the flood of orders resulting from the Rio Olympic Games, right? So because of the Rio Olympic, the fact is mainly the international event happening at that time. Rio Olympic Games between 2010 and 2012, right? Normally, you can see the Rio Olympic Game is the main reason for that in the construction project in 2013 and 2014. This appears to have had a good impact on this profit from 2013 and 14. Both gross profit and the operating double between 2012 and 2014. Both you can say it's right. So they're asking work out both years gross profit margins and operating profit margin. So they ask the GP margins are these, net profit margins are the gross profit margin is formula, gross profit over revenue into 100. So this is 39%, 40.6, 40.9, 49.5, 51%. So it's a kind of improvement. Gross profit margin has improved step by step. Net profit margin also same, 8.1%, 8.7%, 8.7, 10.6%, 10.8%. So this is because of this, we can say the performance has improved, right? The fourth question is a discussion question. Discuss possible reasons for the changes in question 3. Right, okay. This one can, yeah, TJ, can you read this answer, please?
Between 2010 and 2012, both the gross and operating profit margins are fairly stable. They have increased slightly, but not by much. However, in 2013 and 2014, they both rise sharply. This occurred at the same time as the flood of orders. The gross profit margin rises from 40.9% to 51% between 2012 and 2014. This may be because the business has been able to buy raw materials more cheaply. They will have increased production for the orders and may have enjoyed cheaper materials through bulk buying. The operating profit margin has increased from 8.7% to 10.8%. This may be because the business has been able to benefit from economies of scale, that is, perhaps by making better use of their machinery when increasing production. The operating profit margin will usually rise if a business keeps control of its expenses. It appears that Santos Metal Products has done this in 2013 and 2014.
Very good. So this is the way that you have to reasoning out, because every sentence there is a number or year or something is there. The changes, the possible reason for these changes is mainly the secret behind their performance is the Olympic Games. Yes, always the construction industries are normally getting very good demand when there's a economic development or something, international event or something like that, because always construction industry is always a up and running industry. When the country develops, they need to do more constructions like projects, apartments, housing schemes, stadiums. So construction organization, that's why if you are, for example, hardware business or electrical business or whatever, so you might get huge orders continuously because of that, because that's why that's industry. When the business segment, if it is the construction industry, very difficult. It's actually never like mainly the very solid business organization, whatever the economic boom or economic recession, the construction industry have a stable growth. Stable growth is there because the organizations and the household sector, business sector, foreign, everyone, they have demanding for this thing. Construction, housing is a basic need. Therefore, it improves. And also not only that, they can actually buy bulk items because the cheaper materials they can purchase at bulk. So this is another advantage as a result. So business can able to increase their benefit from economies of scale. Because they are purchasing bulk, you can say you can import like a bulk of metal from US or China. That's the thing. So as a result of sometimes better use of their machinery, increasing production, the operating profit margin will usually rise if business keeps control of its expenses. So these are the main advantages, main possible reasons for the changes. Okay. So this is the now we talk about the gross profit margin and the operating profit margin. I hope that you can understand every 2 points. Now I'm going to teach you another one, markup. Markup also is classified as a profitability ratio. This is a formula is markup profit per item over cost per item. Sometimes time they actually can calculate this as a gross profit over cost of sale into 100. So profit per item or cost of item into 100. So in the previous case, Eco Homes, you can see the properties, they have US dollar 236,000 US dollars, and the cost of sale is 200,000. So their selling price is there, cost of sale is there, and they made a profit. Made a sale would be the US dollar 36,000. So therefore, the profit from their sale, that is, they say 236,000 minus 200,000. That's the profit per unit, and then as a result of the, we can say the unit profit per item is 36,000. Cost per item is 200,000. So we can find the markup by dividing 36,000 over 200,000 into 100. That is 18%. So like that, markup, what is a markup and what we can find out through the markup. Markup is used by some businesses to set its prices. So one of the main reasons is that it is a price and guarantees a recover all the cost of production and also generate a profit. example, if Eco Homes decided that it wanted to make a 25% profit, the markup on the property, the price would be have a charge by given. That's why always, if you remember in marketing management, we discuss a pricing strategy called cost plus pricing. So cost plus pricing, so this is the cost value, and then the markup mean the plus, that how much is the percentage of the markup, percentage of profit that we are adding to the cost. So that is the markup. So we can find out from this formula how much markup they are adding to the production cost. So here the price can be determined by like that. For example, if they're keeping a 25% markup on the cost, therefore the selling price would be cost plus markup. So cost is 200,000, markup 25%, which is 50,000. Then selling price we can decide, okay, 250,000. Okay, so what is the use of markup percentage? We can find out the selling price. For pricing decisions, we can use the markup percentage. They can find out initially how much profit margin we are keeping from one production unit. Okay, so markup also keep in mind, this is also formula sheet. It's one part of the formula sheet to calculate the markup. Sometimes the depends on the case study. So therefore, in that case, you have to take the in this kind of situation when you calculate a markup percentage, you have to calculate the cost per item plus into total. I mean that in this case we can directly find out what is the profit per item and the cost per item. In some questions you don't get this information. Sometimes they're giving just a gross profit, revenue figures, cost of sales figures only. So in that case, if you have access to only gross profit and cost of sales, you can use that formula also. Markup equal gross profit over cost of sale into 100. Otherwise, it normally profit per item over cost per item into 100, right? So now we are going to the important section called liquidity. Liquidity. Now all profitability ratios identify. We are going to talk about the liquidity section. The liquidity means amount of money, the amount of reserves of money, something that you can have in order to manage your day-to-day expenses, right? So liquidity is very important concept, right? So about the liquidity, Adil, can you read about the liquidity section, concept of liquidity?
Liquidity is a very important issue for businesses. Liquidity refers to the ease and speed with which assets can be converted into cash. Non-current assets such as property, plant, machinery, and tools are not liquid assets. This is because they cannot be converted into cash very quickly. It may take several months, for example, to sell property. In contrast, current assets are liquid, although some are more liquid than others. Cash is totally liquid and trade receivables are fairly liquid. This is because cash from customers who have bought goods on trade credit is expected to be paid within 90 days. Inventories are the least liquid current asset. This is because the sale of inventories such as finished goods cannot be guaranteed by a business, although the expectation is that they will be sold. If a business does not have enough liquid assets, it may not be able to raise enough cash to pay its immediate bills. A serious lack of liquidity could mean that a business collapses. Two ratios can be used to assess the liquid of a business: current ratio and asset test ratio.
Okay, thank you. So normally the liquidity definition you can see here, it's a very important issue of the business. Liquidity refers to the ease and speed which assets can be converted into cash. It's an important definition you should know. It's the ease and speed which assets can be converted into cash. When you're preparing financial statements, we are classifying this, especially SOFP. When you're classifying our assets according to the liquidity preference, liquidity from the lowest liquidity to highest liquidity. Lowest liquidity items are the things that we classify in the non-current assets such as land, building, motor vehicle, fixtures, fittings, furniture, and like that. So mainly that's first of all, those are non-current assets that have a least liquidity. Like it takes some time to convert into cash. For example, land, it will take some time to convert into cash, right? And then look at the current assets. Current assets mean starting that also from the least liquidity to highest liquidity. For example, current asset normally first one we are classifying is inventory, closing inventory, and then trade receivables, and then provision for doubtful debt you can see, and then other receivables, and then cash in bank and cash in hand. So cash in hand is 100% liquid asset because cash in hand is always readily available cash with you, right? But the least asset you can see in the current asset section, inventory, because inventory also takes some time to convert into cash like that. So liquidity means ease and speed, which assets can be converted into cash. So this case you can see that normally we are talking about the two liquidity ratios in order to calculate. First one is a current ratio and second one is acid test ratio or quick ratio. Current ratio, this is the definition. The current ratio assesses the firm's liquidity by dividing current liabilities into current assets. So how you calculate? It is a not a percentage value, it's a ratio. So their answer always coming as 1.5 or 2:1, something like that. And then current ratio is a liquidity ratio and focus on the current assets and the current liabilities. And it is calculated by this formula: current ratio equal current assets over current liabilities, current assets over current liabilities. So for Eco Homes business for 2016, the current ratio would be 13.6 million divided by 8.7 million. And then that is 1.56, right? The value we can say just 1.56 or 1.56 is to 1. 1.56 is to 1. So for 2015, what happened is gone down slightly. 2015, so 11.9 million divided by 7.8 million, then 1.5. So 15 to 16, we can see this improvement, 1.53 to 1.56. When normally when you calculate the liquidity thing, like there are standards are there. I'll expect you what is standard. So liquidity, you can see in my handout, I have given current ratio. Normally ideal standard should be 2:1. Okay? Ideally is 2:1 because business, even after spending half of its money on repaying their current liability, it has still another half to survive on. That's the main thing. In business world, we normally we are saying current ratio must have a 2:1, at least 2 current assets to settle 1 current liability, right? At least 2 current assets to send 1 current liability. That's the ideal ratio because even if you settle the entire current liability, you have another half to survive. That's the thing. But satisfactory level also there. Satisfactory level means at least you must have 1.5 above, 1.5 above, 1.5 current assets to 1 current liability, right? Then that's a satisfactory level, right? The problem coming here, if you the current ratio is go below the 1.5 level, which go below the 1.5 level, let's say it's 0.5 or something, then it's have a huge, we can say, liquidity issue in there in the business. And on the other hand, if you go more than 2, that's also bad because 2:1 is better because what if you can see 5:1, 5 current assets to 1 current liability. So in that case also we are normally criticizing that business actually haven't fully utilized their cash. That means their unused assets are there. That might are keeping too much of current assets without using in profitable venture. Therefore, keeping so much of assets with you, it's in vain because you must quickly invest that in the business venture. So ideal rate is 2:1. If you have 3, 4, 5, 10:1, something like that, you call underutilized assets, right? So that is the thing that we are talking about. Again, the acid test ratio also like this. So always keep in mind, current ratio best one is the 2:1. 1.5 is satisfactory level. So in this case, both years, it's above 1.5, above satisfactory level. So you can see Eco Home is okay, right? Not excellent. You can say it is good, like liquidity is good, not excellent, right? So but it is depending on the business organization because in every organization we can't say we should have a 2:1 because imagine sometimes some business organization, they don't have enough current assets, but they have enough sometimes other assets. Sometimes they don't have, they are not keeping sometimes, not a lot of current assets because they are investing in their money in different, for example, it's a real estate business or car sale or something. So they're not keeping a lot of current assets, right? They don't have inventories, receivables, but right, they have so much of non-current assets they are keeping. So that case, sometimes their liquidity is low, but the organization is still okay. So normally that's the nature of the business. Right, there is a sometimes there's a case study with there. It's a jewelry business. Jewelry business also there is the liquidity figures are bad, but it stays normally jewelry business. They are normally they have a lot of large amount of stocks they are keeping. right? So that is mainly we are talking with the asset test ratio. You can see asset test ratio is where normally you are removing your inventory out of the current assets, so making the ratio a little bit more diluted. So you make more, it's more volatile. More asset test ratio means the current ratio, from current ratio we are minus inventory. You can see asset test ratio equal current assets minus inventory over current liability. So this is, you make more diluted, the current ratio more diluted, just the diluted version of the current ratio equal acid test ratio. Then we can find out quickly how much money that we have in order to settle the current liabilities, because in the current assets sometimes a lot of organization inventory make a huge part of the current assets inventory. So in what we are going to do here, we are removing the inventory section from the current assets and we divide by the current liability. So you can see the asset test ratio definition similar to the current ratio, but exclude the stocks from the current asset, sometimes called the quick ratio. Okay, so that's why in some organization the inventory plays a big role. As I told you, a car sale, the vehicles mean the inventory. In a jewelry shop, the gold stock is the inventory. If you remove that, if you remove the from car sales, if you remove the value of the inventory, if you jewelry shop, if you remove the value of their gold, so their current asset will be very low. The amount of cash they have with them, and also amount of other assets, settlements, everything they have with them is very low amount. So therefore, that's why depending on the nature of the business, sometimes your inventory will be very important to keep large amount of inventory with you. That's what sometimes the asset test ratio can be good. Here we call how quickly they can settle their current liabilities. So this case, you can see it's 13.6 million current asset minus 4.9 million inventory, then divide by 8.7 million. You can see the it's 1:1. One quick asset to one current liability. Asset test ratio here 2015, you can say it's 0.88 quick assets to one current liability. So that is 11.9 million minus 5 million over 7.8 million, so 0.88. So when you go to discuss the ideals, right? Main ideals ratio here, quick ratio, acid test ratio, ideal is 1:1, which means you must have one acid test, but one quick asset to one current liability. Quick asset means the asset minus current asset minus inventory. So which means you must have 1:1 ratio is the best, but satisfactory level you must have at least above 0.75. That's why we need to know these things, because when you're writing analyze question interpretation parts, then you can find out the figures, the range of the figures, and the range is we can find out whether in business are in the safe zone or in the worst. So why 1:1 is the best ideal, because indicates that the business can pay off all their current liabilities without having to sell their stock. Right, so that's why even you lose the money in paying off the current liability, you still have enough and you won't go bankrupt. That's the thing. So even though that's the thing, but by using your only cash availability, you can settle all your current liabilities. Your financial strength you can find out from that. The liquid level you can find out whether you can show that you are not bankrupt. You have enough money to survive. That is important. Liquidity or working capital. You can see here, working capital is the amount of money need to pay for their day-to-day trading. Working capital, sometimes we call current assets minus current liabilities. This is a working capital cycle, right? Normally, cash coming into the business and then cash going out of the business. Cash coming in from customers, cash going out to the business to suppliers, and the suppliers giving you like inventory, stocks, and then these stocks are going to production process happening in the business, value addition process, and then this finished good we are selling back to the customers, and customer giving us the money. This is a cash flow cycle, working capital cycle of the business organization. That's why the liquidity is really important in order to know the liquidity level, like whether business is bankrupt or not. Okay, so let's look at the activity number 2 case study, comparing assets and liabilities. Right. Patel operates a national car dealership in India. The car dealership means normally it's so much of inventory will be there in the vehicle, and then it has over 60 outlets, mainly in southern and the central India. Uzi Plastic manufacture over 300,000 tons of polythene products, including plastic bags and bottles a year. So it's another organization. So Patel is a car dealership, and then UC Plastic is a polythene manufacturer. Over 300,000 tons of polythene products, They are producing plastic bags, bottles, and then show their current assets and current liabilities for two companies. Look at the figures in 15-16. The Patels, they have rupees Indian million, 81 million, and then gone down to 42 million. USI Plastics, their figures improving 53.3 million, 55 to 59.5 million. Yes, increment. And other current assets also like that, stable. And then total current asset, you can see it's gone down for the Patels, 131 to 62. The USI actually is what happened is improve 119 to 120,000. Look at the current liability, the Patel's business current liability is gone down to 136,000 to 53,000, and the USI Plastics, what happened, that also gone down to 75,000 to 68.3, right? So what are the questions they're asking from this? What are the questions they expect? So normally when you're, this is the very good question to understand the liquidity level. They're asking two questions. Calculate the both companies and for both tiers, current ratios and the asset test ratios. What is the more liquid company out of those two companies? What is the more liquid? Which is the more liquid? Okay, let's see the mark scheme for this, and you can find out what is the most liquid business out of these two companies. Yeah, in the business, you can see in this table, Patel's business current ratio is 0.96 and 2015, and it has improved to 1.16. USI's products, plastics, what happened? This 2015 it was 1.58, and 2016 it had improved to 1.76. By looking at these figures, you can see Patel and USI. Okay, I'm asking this question from the audience. What do you think? By looking at the current ratio, which has the more financial strength, which has more liquidity, Patel or USI? Right? You can ask this. Okay, TJ, can you say what is the what you think? Which company has the more liquidity? Patel's company or USI Plastic company?
USI Plastic.
Correct. Very good. Yeah, I got several couple of answers also. Yes, from Tevin, correct. It's USI Plus because they are 1.56. Definitely is 1.5 above is satisfactory, and they have improved this momentum and go up to 1.76 in 2016. But 2015, the Patel is 0.96. The idea should be 2:1. Satisfactory should be 1.5 above, but here is less than 1.5. 2015 is 0.96. 2016, they have improved the situation, but it's still below the ideal and below the satisfactory level. So by looking at the figures, you can see Patel actually having some liquidity issue in the business organization. Yeah, USI is actually safe because they are maintaining above the satisfactory level, but not ideal. But though it's not ideal, they are okay because more than 1.5 is there. But look at the other one, acid test ratio. Acid test ratio, I told you 1:1 is the best, and above 0.75 is the satisfactory. USI Plastic, they also, you can see they are maintaining over the satisfactory level. 0.85 to 0.89 is improved, and they are okay above 0.75. But Patels, you can see they are very dangerously, they actually gone down. It's less than 1:1 and is less than 0.75 also. That's actually 0.36 and 0.37. It's very bad. By looking at these two companies, we can, by looking at the numbers, we can find out company Patel actually struggling to survive because they don't have enough money, enough assets to survive. But whereas USI Plastic, they are comfortable, they're in the comfortable zone because they have enough assets, current assets to pay their current liabilities, especially current asset as well as asset test ratios also same. After removing the inventory from the quick assets, they can settle their current liabilities. They have 0.85 current assets to 1 current liability. That is satisfactory level, right? So the second question asking which is the more liquid of those companies? Which is the more liquid of the two companies? Okay, Kiara, can you read the answer, please?
Yeah, sir, the second one, right?
Yes.
According to the calculations in one, USI Plastics is the more liquid of the two companies. The current ratio in both years for USI Plastics lies in the preferred range of 1.5 to 2. The acid test ratio in both years is just below 1. Patel's figures are significantly worse. The current ratios in both years are well below 1.5. and the acid test ratios are well below the preferred target of 1. Between 2015 and 2016, both companies have improved their liquidity position slightly. For example, the current ratios for both companies have increased. There may be a reason why Patels appears to have a poorer liquidity position than Uzi Plastics. Patels is a car retailer. It sells cars from car showrooms. Consequently, its main asset will be inventories, the value of cars in the showroom. This would explain the low acid test ratios. It is also possible that Patels is paid immediately when a sale is made. It may not have to wait for customers to pay. Therefore, it does not have to wait for cash. This means they can operate with much lower current and acid test ratios. BBG Plastics is a manufacturer and probably allows its customers to trade credit. This means they have to wait for cash and therefore need higher liquidity ratios to be safe.
Yes, very good. So normally by looking at this thing, they're giving the nature of the business, they are comparison. For example, these two companies are not in the same industry, right? The Patel is a car sale, a vehicle dealer, and whereas Uzi Plastic is a plastic and polythene manufacturer. You can see they're two different nature. So they are selling like a solid, vehicles. The vehicles are slow moving items. Like normally, it takes some time to make a sale. So therefore, they have a lot of inventories also there. And it takes some time to sell a vehicle. But look at the plastic bags, polythene bags. So it is actually a convenient good, and as well as it's very fast moving consumer good. So you can see the turnover wise, this one plastics have a huge, high turnover than the vehicles. So you can see that's the first paragraph. They try to mention the values actually better or worse. This case they're giving the preferred ranges 1.5 to 2, satisfactory level and the ideal level. So both actually got the Uzi Plastics side, the comfortable zone, they are between the range. But the other company, Partners, actually, they say they are worst. So both companies have improved their liquidity slowly. Both, if you take slightly, both their figures improved slightly. For example, current ratios for both companies have increased. Here 0.96 to 1.16. Here 1.58 to 1.76. So you can see the positive momentum is there. And there may be a reason. The second para, I like to actually highlight the second para. There may be a reason why this thing. So reasoning out is the most important thing. That is the thing. Knowledge and application, analysis and evaluation skill, like your higher level skill. You can show from the thing. You're suggesting that because Patel appears to have a poor liquidity position than the Uzi, because Patel is a car retailer, right? It sells car from car showroom, right? Whereas consequently, its main asset will be inventory, like a value of cars. If the car in the showroom is the main assets. This would explain that the low acid test ratio. Low acid test ratio because of that, because vehicles represent most of the majority of the assets. So they don't have cash, right? Do you think that car sales are keeping so much of cash? Why they need cash? They are earning cash. They don't need to pay, right? Sometimes car sellers, sometimes they are using a bank for that thing. Say when importing vehicles from Japan and other countries, sometimes they might use bank cash in hand and cash in bank. Like sometimes they are using a bank loan for that in order to bring the vehicles into the country. So like that, so they don't keep any cash with the business, no money in the bank account. So basically, their asset test ratio is low, right? That's the nature of the business. So it is also possible that Patel paid immediately, because we can say immediately you can settle everything, because when there's a vehicle is there, when you have a sale, then you can get the cash immediately, and they may not have wait for the customers to pay, because now immediately customers also can go to the car loan or vehicle lease or something, and accordingly Patel can immediately receive the money, paycheck they can have. Therefore, it does not have to wait for the cash. That's the thing. So this means that they can operate with much lower current asset test ratio. That's why the current liability they can quickly met, because immediately they can settle. And there's a vehicle sales happen, immediately they can settle. Therefore, they don't need to keep any amount of money with them. But on the other hand, the Uzi Plastic manufacturer and probably allow the customers to trade credit. Definitely, it's a fast-moving consumer good, so I have to give it on trade credits. So this means that they have to wait for cash. Therefore, need higher liquidity ratios to be safe. They have to wait for cash, because normally, why you want to keep more cash with you when you're allowing trade credits, like credit sales? If you are doing, you have to keep more cash with you, because we don't know whether that's why cash flow, the working capital cycle is there. You allow customers on credit terms. So customers, sometimes you right now you're selling and the customer is expected to pay you within 2 months. So within that 2 months, you have to maintain your business. You have to pay your bills, you have to pay your salary. So everything you have to keep some money with you. But Patel is not like that. Patel, they're not selling vehicles for credit. They are selling only ready cash. So customers can arrange different availabilities like lease options, bank loan options, right? So Patel definitely getting quick money, but here Uzi Plastic, they have to wait for some couple of months or a couple of weeks until the customer settle it. That's why so Uzi has to keep low, very high liquidity in that case, but Patel don't need to keep that much of liquidity because that's the nature of their business. So that's why by looking at these figures, when you make comparisons, it's very difficult to make a comparison like that. Why? Without knowing the nature of the business. If both businesses are in the same industry, then we can definitely say Patel actually having some problem. But since the business industries are different, car industry and the polythene bag industry, so therefore there's a significant difference is there regarding the having enough liquidity with them. Right, so this is the way the liquidity and everything you can actually analyze liquidity levels. We talk about two liquidity ratios, acid test ratio and the quick ratio, right? Acid test ratio, current ratio and the acid test ratio, right? When you're making ratios to make comparisons, right? So this one I invite TJ, can you read again? Using ratio.
Ratios can be used to access the performance and the liquidity of a business at a particular point in time. They can also be used to monitor the progress of a business over time. The statement of comprehensive income and the statement of financial position both show the figures for the current financial year and the previous financial year. This means that the ratios can be calculated and compared immediately. For example, the ROCE for Eco Homes calculated above in 2015 is 17.8% in 2015 and 23% in 2016. It shows immediately that performance has improved significantly. It is also possible to track the historic performance of a business over a period of time. For example, by comparing the ratios over, say, 5 years. Financial analysts looking to invest funds in companies might do this. Ratios can also be used to make comparisons between businesses in the same industry. This will help to judge the performance of a business compared to its closest rivals. For example, in 2015, the operating profit margins for Ford and Honda were 6.8% and 5% respectively. This suggests that in 2015, Ford performed better than Honda according to this particular measure of performance. However, care is required when using ratios to compare the performance of different companies at a particular point in time. There may be a number of reasons why the ratios are different. For example, Ford and Honda might have quite different product lines. They might have invested very different amounts in research and development in that particular year, or they may have spent a huge amount launching a new car in a new market.
Okay, thank you. As you can see, the using ratio analysis, you have to, this is the main thing, the summary of this lesson. Like when you're making ratios, why we want to use the ratios to make comparisons. You can make comparisons by looking at these ratios, especially like there are some certain ratios you might learn in future, like price earning ratio, earning per share, dividend payout, like that. Particularly when you're doing investments, the ratio analysis is really important. But this level, we are going to mainly, we are going to understand the current ratio and the acid test ratio for the liquidity and gross profit margin and operating profit margin and the markup ratio for the profitability. Right. There's another one called ROCE. So return on capital. You can see now this case study, this paragraph is mentioned separately. You can see you have to, when you're making comparisons, you have to think about the different company, structure of the company, the industry of the company. You have to think about, for example, Ford and Honda. Ford and Honda, same industry, automobile, and might have a quite different product lines. They might have invested very different amounts of research and development, even though in the same industry, right? Their product lines are different, right? Honda normally they are targeting like a low-cost products, right? Low-cost products and differentiated products sometimes. So they are selling to mass market, right? Ford, if you talk about the Ford vehicles also, the Ford might have different product lines, sometimes differentiated product, and not the like low, like a cheapest, like a not the cost leadership products, sometimes they are achieving the strategies like differentiated product aspect they are going to focusing on, like Ford Ranger and the Ford vehicles. Like normally it's not cheap, it's expensive, but look at the Honda vehicles comparatively, these Japanese vehicles are normally is cheaper than the Ford vehicles. So they have different like a product develop, research and developments are different. Therefore, they have to spend a huge amount of money to launching a new car into the market, right? These facts and figures also, not only the numericals, not only the numbers, you have to take care of these facts and figures also when you're making comparison. Always, when you're writing answers, think about the industry and how it perform as well. Okay, so now we can see the most business, large and small business, owners are unlikely to use their ratio analysis, right? They may not be aware of the method, and they may not have access to the information needed to perform the ratio analysis sometimes. Then they may not produce amount of the business. However, many small businesses will understand how profit margins can be applied, and small businesses might have specific margin to that they want to achieve. For example, finance department in large businesses are likely to use the ratio analysis. They may be required to analyze the performance and the financial position of the business in much more detail on behalf of the shareholders. So you can see large business actually they like to do more ratios, whereas small businesses they don't have sometimes that much of intention to do the ratio. But both large and small businesses, they are mainly beneficial from by looking at this. Even the bankers, definitely they will do this ratio analysis, like investors. Before you apply for credit, before you apply for a loan, sometimes they might go through some kind of a ratio analysis to interpret the financial statements, right? So in my today's session, I talk about the three ratios, right? Mainly one profitability ratio called markup, and also I talk about the two other ratios, liquidity ratios, current ratio and the acid test ratio, right? And this I told you about the acid test ratio and the current ratio, the ideals, right? Normally the ideals current ratio should be 2:1 ideal ratio, and satisfactory ratio should be 1.5:1. Whereas acid test ratio idea should be 1:1, that is one quick assets to one current liability, 1:1. However, the satisfactory level is 0.75:1. Okay, so from this, the entire ratio part for this IGCSE section is done. So in my next session, I'm going to explain you some other couple of questions and past paper questions, and mainly how to write proper questions, especially analyzed question, along with the because every past paper question there are some analyzed questions are there along with the calculation. We'll see how we can answer those questions in other coming sessions. Okay, thank you. Right.